Hello, hello, Jamie here. It has been a little while. I feel like it's been a while since I've done a live. It's only been, I guess, 2 weeks. Is that right? 2 weeks. I took all of last week off. I was hanging out at the beach, you guys. I hope that everybody has some downtime planned for the summer because I'm going to tell you it was the best. It was the absolute best. I read 3 books. 3 fiction books. I normally read nonfiction. I read 3 fiction books at the beach, sitting by the pool. It was amazing. I highly suggest taking some time off. I think we all need it after the last year. I don't know about you. So I have a couple different vacations. I went a little crazy, like booking just different little trips and little things here and there that we're gonna do this summer because I need to get out of my house. So it was really exciting. So I missed you guys. I missed you, but I didn't miss you that much. I didn't miss you that much. So, but I'm excited to be back. I'm excited to be back in the swing of things and here to give you a live training. So tell me you're here when you're here so that I can make sure that I can see you and make sure that everything is working. Because again, it's been a little bit. So hopefully my tech is working. Hey, Lindsay. Hi, guys. So today we're going to be talking about a topic that I think is super duper important, and it is one that is overlooked a lot. So I love talking about financial statements. For those of you guys that know me, I know that's like the nerdiest thing someone could say. I love talking about financial statements. I'm such an accountant. I'm showing, my CPA is showing. But I really do because I think they are so useful and they are so underused. So you guys probably know about the P&L, right? Your profit and loss is probably the financial statement that is most used, that you're most familiar with. Your profit and loss is what's going to show you your income and your expenses, and then your profit at the end of the day, which is what you pay taxes off of, right? So your P&L is something that you're probably, hopefully, looking at regularly. You may or may not be also looking at your balance sheet. You may or may not even have a balance sheet. So I want to talk a little bit today about what exactly is a balance sheet, because I think that is one of the things, like we don't use it necessarily day to day in our business, or most of you probably aren't using it on a day-to-day basis, but it is super important and can give you a lot of information. And so I want to talk about what it is and who needs one, right? Does everybody need one? And the answer is actually, well, not everybody. A lot of people need one, but not everybody. So I'll give you kind of an overview of who I think really should have a balance sheet and should be paying attention to a balance sheet. Over time, as your business grows, you will have a balance sheet. More than likely, that should be the goal. But in the beginning, maybe not. So let's really quickly, I'm going to bring up real quick, just to kind of, so that you guys know what I'm talking about. I think a visual is worth 1,000 words. So what do I mean when I'm talking about a balance sheet? If you're not familiar with it, and let me see if I can blow this up a little bit. Hang on. It doesn't really want to let me. I think that's here we go. That's where it is. That's where it is on here. Okay, there we go. Can you guys see it? Hopefully you can see it. Hey, April. Okay, so this is an example of a balance sheet. Now, you may have some of these accounts, you may have none of these accounts. Your accounts may look very different, but I'm going to talk through a couple of the things. So overall, let's talk overarching. What is a balance sheet? A balance sheet is going to show you what you own, what you owe, and what your ownership is in the business, okay? What you own, what you owe, and what your ownership is in the business. Okay, so you're going to see, and oftentimes, depending on what you're running this out of, you may see this as one long thing, or it may be in 2 columns like this. It just depends. And so on this side, on the left-hand side, or at the top, depending on how your balance sheet is set up, you're going to see assets. Assets are what you own, right? We kind of understand that, like an asset is a thing. Usually it's something physical. Not always, however, right? So an asset is a thing that you own. So in this case, cash is probably the thing that everybody hopefully has a bank account and has cash running through it. So every business should have cash as that top asset that's going to show up on your balance sheet. And for some businesses, that might be the only asset you really routinely have, okay? So let's talk about, I'm not gonna go too deep into accounts receivable and accounts payable, but I will say one thing. You may or may not have these on your balance sheet, okay? You may or may not have accounts receivable and accounts payable. Who would have these? Well, somebody who's using the accrual method of accounting. So there's the cash method and the accrual method. This is not a live about the accrual method of accounting. If you're doing the accrual method, you probably know that. And if you're in something like QuickBooks, there's usually a toggle at the top where you can go back and forth between cash and accrual. Most very small businesses are probably doing taxes on a cash basis. Now, you still may, however, want to track your books on an accrual basis. That's why you can go back and forth in QuickBooks. You can do both. But basically what accounts receivable is maybe you've invoiced a client and they haven't paid you yet. So you have a receivable outstanding, right? But if you are under the cash basis, which means you don't recognize that, you don't include that in revenue until you actually get the cash, you're not going to see accounts receivable on your balance sheet. That just won't be here at all, because basically it's a non-event until the cash comes in the door if you're cash basis. So that's all I'm going to say about that. Maybe I'll do a live later if you guys are interested in understanding more about the cash versus accrual method. But that's kind of the general thing. So you may or may not have that. You may or may not have inventory, right? You may or may not have inventory, meaning if you are buying things to resell, or you're buying, it could be finished product inventory, right? That you're holding finished products to sell. Or it could be materials inventory. You're buying materials that you're then going to create something that you will sell. This isn't for like materials you're going to use in other parts of your business. This isn't like notebooks that you're writing on. That's different. But these are things that are going to eventually be sold in your business. That's what inventory would be. So that's going to sit on your balance sheet. So what that means is if you're buying something, it's usually either going to be a P&L thing or a balance sheet thing. Inventory starts on your balance sheet. And as you sell it, that's when it's going to come off your balance sheet and onto your P&L, if that makes sense. So there's a little bit of a timing difference sometimes with when cash goes out and where it goes. Again, I don't want to get too far down deep into that. This is an intro to the balance sheet. But know that if you are a business that has, goods that you are selling, then you likely will have inventory. And different people are going to track that. Some people are going to track that routinely, maybe every single month, or maybe you're just doing an inventory adjustment quarterly or even at the end of the year for taxes. But ultimately, you will see inventory likely on your balance sheet at some point in time. We're not going to talk about prepaid expenses. That's a little bit advanced for this conversation. And we're not really going to talk about investments, or if you were also investing in anything in your business. So that's more investments like stocks and bonds or something like that. Okay, so that's kind of your current. Current means you're planning to use them, or these are within the next 12 months, right? These are assets that you're planning to use within the next 12 months. And generally cash is always going to be a current asset. Accounts receivable, inventory should be a current asset as well, although sometimes you might have some that is longer term in nature. So basically those are your current assets. Then you're going to come down and these are going to be your longer term assets, which you may or may not have, right? So those are going to be often fixed assets. That's property and equipment, right? So that means land, building, equipment, machinery, right? If you own a car that is titled to your business, it probably is going to show up, or it should be showing up on your balance sheet. And these long-term assets, you buy them and you put them on your balance sheet at cost. And then you see this line here, and we're going to talk a little bit more about depreciation probably next week. There's a line that says less accumulated depreciation. Well, that means that over time, the value of, let's say, a car, right, is going to go down over time. And so what you do is you depreciate that. So you're essentially taking part of the balance of it and moving it from the balance sheet, taking it off the balance sheet and putting it as an expense on your P&L over time. So when you're deducting depreciation over time, like you buy a car, most of the time, in some cases there are some tax rules where you can deduct the whole thing in 1 year, but most of the time, any assets that you're purchasing are going to be depreciated over time. Why, you ask? Well, because you're going to be using them over time. And again, we'll talk more about this later, but ultimately you're going to have these longer term assets which you're buying to use over more than just 1 year. These are things that are going to help you make income into, the future, and therefore they are considered to be long-term assets on your balance sheet. That's why most of the time you're not going to deduct some of these things in the first year that you buy them. So your cash won't necessarily match with your P&L because of that. Okay, so and then there's some other ones. We're not going to talk about intangibles. I'm pretty sure most of y'all probably don't have intangible assets on your balance sheet unless you've been through a bit like a merger or something like that, or an acquisition. That would be the only reason. And then let's come over here to liabilities and shareholders' equity. So like I said, assets are the things that we own. Liabilities are the things that we owe, right? So what do we owe? So this is going to be, I talked a little bit about accounts payable, but this is largely going to be debt. That's the most, ignore some of these, again, more complicated ones. Largely, you're going to see debt over here on the liabilities. It might be short-term if it's something like credit card debt, right? Like your monthly payments and things like that. That might be short-term debt. Or if you have long-term debt, if you took out an EIDL or something like that, or you have other long-term debt, that's going to show up down here under long-term because it's more than a year generally. So debt is one of those things that you owe, right? And that's going to come off your balance sheet as you pay the debt back. Then that balance is going to get reduced, okay? So that's assets and liabilities, and those are important to be able to pay attention to and know what your assets and liabilities are, right? And you want to make sure, right? One of the things that, is oftentimes looked at, if I'm looking at a stock to buy or something like that, I will pull up their balance sheet because I'm curious to see, well, how healthy is this company? Your P&L will tell you, okay, here in general is what's going on over this period of time. Your balance sheet can give you a snapshot into the actual health of your company. What I mean by that is, if you have a balance sheet and you have very little current assets, maybe you've got $5,000 worth of cash, but you have, short-term current liabilities, short-term debt that's due of $20,000, well, you got a liquidity problem there, is what I would consider that, right? So you would say that, that you want to make sure that your current assets are higher than your current liabilities. If they're not, then that's what can cause cash shortfalls and things like that down the line. So you want to be paying attention to that to kind of get an overall view of the health of your company at a given point in time, right? In general, we want to have more assets than we do liabilities. You have an issue if you're consistently having more liabilities than you do assets in your business. That is the writing on the wall for a problem that you need to address. So that's, again, something that's really, really important to be paying attention to. And let's talk about equity. So this is the one I think that confuses people the most, right? We're coming down here to equity, to shareholders' equity. Thanks, Lindsay. I'm glad this is helpful. I mean, it's hard. I'm trying to do this in a crash course kind of way. I mean, I could talk about the balance sheet for a while. This is just an overview, but I want to give you guys kind of a viewpoint. So equity, and you're probably, truthfully, if you're running something out of Quickbooks or something like that, this probably isn't what your equity looks like. You probably have something like owner's pay on there. You maybe have owner's contribution or something like that on there. And you might have like retained earnings and net income. That's probably what your equity looks like. But overall, what equity is, it's your ownership in the business. And here's what's interesting. You'll see here, your assets, your total assets, always equal the same as your total liabilities and shareholders' equity. Why? Because it's a balance sheet, you guys. It's got a balance. So it's got to add. So for example, if you take money out of your business to pay yourself, it's going to reduce your equity balance. Let's say you take 10,000 out. Well, now you're at 462, right? 462,100. Well, how does it balance? Well, now your cash is less too because you've taken $10,000 cash out. So your assets also are 462,100. So you're going to see instances where you should always balance out. It should automatically happen that your balance sheet will balance. When you put money into your business, right, your cash is going to go up and your equity is going to go up. So that's really kind of how that interplay works. When you buy, let's say, an asset, your cash is going to change. When you pay a liability down, right, your liability is going to decrease, and so is your cash. So it's all a balance. All of this kind of works together to balance out all the time. There's always a counterpoint to, when that's kind of like what double entry bookkeeping is, right? You're always going to have a other side of the equation. So hang on, let me look at these questions here. Let's see. Yes. So yes, in QuickBooks, you can change it so that you don't, it usually will default to accrual unless you change the settings. So yeah, absolutely the case, because sometimes that can get confusing when you're like, I don't know, I don't want to see AR and AP, but it can be helpful. Yeah, so yes, so I think that can be changed in the settings, so check that out. Sometimes it's useful to look at both, even if you're cash basis. If you're sending invoices and things like that through QuickBooks, right, it'll show you what's still outstanding. That's what your accounts receivable balance is. That's invoices likely that you've sent that have not been collected. So that can be really helpful to have, even if you're not accrual basis. It can just help you sort of do that. So equity isn't a liability, right? So that's important. So it's liabilities and shareholders' equity. So equity itself is not a liability. You have assets, and then you have liabilities and equity. And all it's saying is that you add them together to balance out with your assets, right? Because they move similarly, they move in the same direction, if that makes sense. So like I said, when you are, taking money out of your business, that's going to decrease your equity. That's going to decrease your asset or your cash, right? Your assets. So there's always that other point. That's why but it's not actually a liability. Your equity is not something that you owe, right? Your equity is what the ownership interest is in your business in total. So that's important to know. Usually you want to have a positive equity balance, but if you're taking money out continually from your business, right, then you're going to have a lower equity balance, and that's okay. You're using it to pay yourself. That's not a problem. You don't necessarily want to have a massive equity in your business, because the point of our business is also to be able to pay ourselves. But if you're building up, equity and cash to be able to reinvest in your business, well, that's totally fine as well. So I'm going to take this down a second. because I want to talk about who needs a balance sheet, right? Like, do I need one? So you may be running this. If you use something like QuickBooks Online, not QuickBooks Self-Employed, but QuickBooks Online, you have a balance sheet. You can just go to your reports function. Hang on, I'll show you guys that really quick. Okay, so if you're in QuickBooks, right, you're always, just like your P&L, you're gonna go to reports. It's probably saved up here under your favorites, but if it isn't, it's gonna be down here under your business overview. You'll click your balance sheet and it'll pull it up. And it's gonna be a long balance sheet that's gonna look more like this probably, but that's where it's gonna be. And this is when I was talking about toggling between the two. Unless you change the settings, it's probably going to default to accrual, which will show you AR, right? If I change this to cash and press run report, you'll see that the AR and AP both disappear. They don't exist anymore, because that's the main difference between cash and accrual basis. So you can change that on there. So if you are a business that's running in QuickBooks Online, you already have a balance sheet. So go check it out, run it, see what it looks like, see if it makes any dang sense at all. It may not, that's completely fine. But if you're doing like your account reconciliations and things like that routinely, then your balance sheet should roughly make sense, right? Your cash balances should agree out. You should see your debt on there, that kind of thing. Now, who doesn't need a balance sheet? I'll start with that. Who doesn't need a balance sheet? If you are a 1099 contractor who has no real assets in your business, right? Like nothing, like no assets that you hold that are that you're deducting for tax purposes, things like that, like larger assets, machinery, equipment, things like that. If you don't have inventory, if you are so you're just 1099 contractor, no assets, no debt, just all you really have is cash, that's it, you might not need one. You may not. Now, maybe eventually you'll want to have one, but you may not need one. In those cases, that's where things like like QuickBooks Self-Employed and some of these more single-sided, single-entry bookkeeping systems come in. Why do I call it single-entry bookkeeping? Well, because all those like QuickBooks Self-Employed is just creating a P&L for you. It's not creating a balance sheet. It's not looking at the other side of every transaction. So it's really more just for tracking expenses. That's generally what those types of things are, but they're not creating all the other reports that you would want to have in your business, especially as your business grows. So who does need a balance sheet? Like if that is not you, if you have a little bit, even a tiny bit of complexity, if you have any kind of assets that you are, deducting for tax purposes, like inventory, right? Inventory or machinery and equipment, if you have a car titled under your business, if you have other assets within your business, right? That you're maybe tech assets, things like that you're using, then you would want to have a balance sheet. If you have any debt at all, right? Any debt at all. If you took on the EIDL, maybe that's your first debt and you've never had a balance sheet before, we need a way to track that balance and record that correctly within your accounting system. So you're gonna want to have a balance sheet, right? That'll show the debt and show your debt balance. If you, let's see, if you want to get outside investing, right? If you're going to bring on a new partner, or if you're going to go out to get debt, like if you want to go acquire debt, or if you want to bring on a silent investor into your business, you're going to need to have a balance sheet. That's one of the things that they are going to ask you for anytime you're trying to raise capital or get debt, okay? And if you have multiple different people, owners in your business, you absolutely need to have a balance sheet because you can track each owner's equity within the business. So if you have multiple owners, you need to have a balance sheet because you need to know what everybody's balance is, what their equity balance is, what their ownership interest is within the business. So you can see there's a lot of reasons you're going to want to have a balance sheet. You may or may not need one for taxes, depending on the type of entity that you are. But in most cases, in like 90% of cases, it's a good idea to have a balance sheet that you are at least looking at maybe quarterly. That's generally, you don't need to be looking at the balance sheet constantly unless you, you have a lot of stuff going on, but at least quarterly, pulling up your balance sheet and seeing what it looks like and getting familiar with reading it and understanding, looking at your current assets versus your current liabilities. Are you going to run into a cash crunch at some point in time because maybe your current liabilities are higher than your assets? Those are good and important things you can learn from your balance sheet, that if you don't have one, if you're not looking at it, you're not going to know. Let's see. I'm looking through to see. For budgeting, if you're looking for budgeting, Jody, I've used two different things. Mint is free. It's Intuit product, just like QuickBooks is. It's got an app, and it's great, but it's more just categorization, right? You can set up budgets, or you can use something like YNAB. I really like YNAB. It's got like a small monthly fee, but it's zero-based budgeting. If you use YNAB, people love it. Love it, love it, love it. So JamieTrull.com/YNAB, YNAB, if you want to check that out. Yeah, so here's the thing about equity. Equity is an interesting one. I wish I could pull up. So most of the time, let me know what you have in there, because most of the time, here are the things that you're going to see within equity. Retained earnings. What is retained earnings? Retained earnings is, I'm going to start with a different one. Net income, right? Your net income will show up there. Your net income on your balance sheet, when you're running that, should agree to your year-to-date net income from your P&L, okay? So as you earn money on the P&L, that's adding to your ownership equity. Your ownership is worth more because you've made money, you've profited in your business. So your net income usually is going to equate to your profit in that current year. So in 2021, you're going to look and you're going to see, okay, yes, that's my net profit. That agrees back to my P&L year to date. So that's adding to my equity. Your retained earnings is all your profit that hasn't been distributed, right? After you've taken out, your owner pay and things like that. Your retained earnings is all your prior year earnings added up together, okay? So everything that you haven't taken out. So let's say you started your business last year and you made $50,000 and that was your profit. and you had taken out $40,000 in owner pay, so you had $10,000 left, that will be your retained earnings. So you'll still have that retained earnings there that you can kind of draw on if you wanted to, right? And take additional money out of your business, assuming you have the cash to do so. So that is what you're usually going to see: net income, retained earnings, owner pay. It's sometimes called owner's pay and personal expenses, because if you accidentally run personal expenses through your business, you can categorize them as owner pay. I don't recommend running personal expenses through your business. It's not a good look, and you don't want to do it, especially if you're an LLC, because that can cause some legal issues down the line. But QuickBooks does have a way that you can just call it either owner pay, you're taking money out, you're taking an owner distribution to pay yourself, right? Now, this is for people paying themselves through owner draws. That's what's going to show up through equity. Oh, this is interesting. So shareholder equity, capital stock, and shareholder equity distributions. Distributions are going to be the things that you're taking out of your business generally. Capital stock, it might be called capital stock, common stock. It could just be called, what do they call it on here? Oh, they don't. There's various different names for it, but oftentimes or owner's investment. Oftentimes that's if you put money into your business to start your business, that's kind of your stock balance, or if people invested into your business to start it. If you had to put, seed money into your business, that's usually when you're investing in. So it's basically all just transactions between equity is just the money that you and other owners have put in, the money that you and other owners have taken out, and the money you've made in your business. That's what makes up your equity balance entirely, right? Let's see. Yeah, members draws. So again, these are all just different names for the same thing. Opening balance equity. Again, that might be a capital contribution you made over time, or that might just be like an adjustment thing. It shouldn't be huge for opening balance equity. It should just stay whatever it was at the beginning of your business. I think I have a weird $300 opening balance equity. I'm not even entirely sure where it came from, but sometimes it's a weird, software thing. But member draws are what you've taken out. Retained earnings is what you have made over time. Net income is what you've made that year. So it's all just money you've put in, money you've taken out, or other owners if you have other owners, right? And money you've made in your business. That's what it is. That's how you add up and reconcile out your equity. Yeah, many might see a balance in uncategorized asset. That's generally a dump account QBO uses, and the transactions should probably go somewhere else. Yeah, so uncategorized assets, and then oftentimes there's also like the undeposited funds account too, which is usually like a pass-through account, which eventually, you may have balances in that because of timing. But yes, there are some things. If you see some weird uncategorized asset, or uncategorized liability, you want to jump in there because that usually belongs somewhere else, and it might belong on your P&L. So you want to make sure that you're paying attention to that. Money I have taken out is shareholder distributions, but you're an S corp. So usually an S corp, you're gonna pay yourself through both distributions out of equity. That's your owner draw, and you're gonna pay yourself your W-2 paycheck, which will come through your P&L. Right? So you're not going to see in equity the transactions that are being paid through your P&L, that are being paid through payroll. Those are going to show up differently. That's actually going to come through in your net income, if that makes sense, right? Because it's reduced your total profit because you paid yourself out before profit. So your net income is going to be lower because you paid yourself through payroll as an S corp. And then you're going to see the distributions that you're taking out of equity as your shareholder distributions, if that makes sense. So that's where equity can get confusing, when you're an S corp and things like that, when there's more going on, right? Because you might look at that and say, okay, like, hang on a second, I've taken a lot more out of my business in this, but that's just your draws that you'll see there. Everything else will impact the net income line. Okay, good. Glad that makes sense. It's hard to talk through without all my slides and all my things. Okay, so I hope you guys found this helpful. I do think the balance sheet is just one of those areas that gets really confusing. And so even if you're still totally confused right now, I understand. It's hard to do this without all my presentation materials and everything like that. I go more in depth, and I have other topics on other financial statements like the P&L, like your cash flow statement. If you guys want to know about that, that's another statement that most people should have. I have my financial fitness basics course that is available. That is a crash course. It's only 3 modules. It goes through the things only you need, what you need to know, right? There's all this information out there, right? You're not going to go get an accounting degree to be a business owner, but you need to have foundational knowledge in accounting, finance, and taxes. And that includes financial statements. That includes, how to calculate your taxes, pay quarterly estimated taxes, what entity structures, how those differ, all of that. Thank you, Jody. Yes, so Financial Fitness Basics, that's my basics course. It's separate from my, signature CFO strategy course, but it is available now. So if you guys want to check it out, it is something that you can do in less than a week, right? Like a couple hours, 1 or 2 hours a day for like 3 days, and you can get the whole thing done, and you can feel like super confident about it. Oh, good point. Yes, estimated taxes. Actually due yesterday. Yes, June 15th. Yeah, it is yesterday. Make sure to pay them. Let's see. Yes. Oh, good. I'm glad you're accountant. I think that Financial Fitness Basics is a great course when you're like, I don't even know how to talk to my accountant, or I don't even know if I need an accountant. I don't know what I need to be doing. I don't know if I need to be, how I need to be tracking expenses, what I need to be doing for all of this. It can help you. We have a jargon decoder that'll help you be able to like translate what the heck your accountant is saying to you. So, oh look, I love that you're looking at your balance sheet while we're talking about this, Cami. That's amazing. Yay, that's a win. I always like that because I always know when I jump into my books, I'm like, okay, I'm gonna look at a couple of things and that'll tell me how long this is gonna take me to do. And so my balance sheet is one of the things that I will pull up and look at and say, okay, I got some work to do if I've got some uncategorized assets. Let's see. Yay, I'm glad. Yes, having a bookkeeper is a game changer, you guys, for not having to spend all of the time in the world on all of this stuff. And then you can just focus on really functioning as the CFO, which means getting the reports from your bookkeeper and reading them and understanding them and getting familiar with what they mean. I think when we're in it, like when we're sitting in there categorizing expenses, doing all the things, it's really hard to take a step back and then say, okay, what does this mean? Right? But when you have somebody else that's preparing reports that are already useful to you, plug for April, preferred vendor. We have a whole preferred vendors list. April is one of our bookkeepers on our preferred vendors list. If somebody wants to drop the preferred vendors list, I will put it up there if you're looking for a bookkeeper, because that can be really helpful too. When they just give you the reports. Yes. Ooh, I like this. I should tagline that, Cami, from shoebox receipts to totally organizing your finances. I like it. That's that's the new tagline. All right, you guys. I will talk to you. I'll be back next week. I think we're talking depreciation a little bit more next week, so that kind of goes with this topic. So make sure to jump on because you'll understand a little bit more about, well, wait, so if I put assets on the balance sheet, then like, how do they come off of there? And how does this whole, how does this work, with depreciation, and what does it mean? Why does it not match with the cash piece of things? Thank you, Jody. You guys are awesome. Jody's monkey on her head always makes me laugh. It brightens my Wednesday. Oh, goodness. Okay, guys. Love y'all. You're amazing. I will be back soon. And I hope you have a fabulous, fabulous rest of your week. Bye, guys.